You ever scroll through home listings late at night, see a place that looks fine, and the price is $500,000? The kitchen feels like it belongs in an older apartment. The backyard is small. The house is not huge. Then the listing calls it move-in ready, like that phrase is supposed to make the price feel normal. And you're sitting there thinking, am I missing something? Did everyone else get a raise except me? Today I want to do something simple and practical. We're going to run the numbers on a $500,000 home in 2026 and answer one question. Who can afford that house and still have a normal life afterward? A life where you can pay bills, save money, invest for retirement, and handle surprises without panic. Because a lot of people focus on one thing, the mortgage payment, or the bank approval, and that creates confusion. Approval is a lender's decision about risk. Affordability is your life. Those two things can land in very different places. Here's the reality. In many markets, $500,000 is the floor. It's not a luxury home price. It's a standard 3-bedroom in a decent area within commuting distance. And median household income in the US is around the mid-$80,000 range. So you get a big gap. Home prices that moved fast, incomes that moved slower. So let's slow down and do the math the way your budget experiences it. First, we need to talk about the down payment, because this is the first wall most people hit. The old school standard is 20% down. On a $500,000 home, that's $100,000 in cash. And that's before closing costs, moving, and buying basic stuff for the house. A lot of people hear $100,000 and their brain instantly says, okay, so I'll do 10% instead. That's common. Some people do 5%. Some first-time programs go lower. The smaller down payment gets you in the door faster, but it adds costs that show up every month. One of those costs is PMI, which stands for private mortgage insurance. Here's what that means. When your down payment is below 20%, the lender adds a monthly insurance charge. It protects the lender if you stop paying. It does not protect you. PMI can vary a lot, but it often lands somewhere like $200 to $400 a month, depending on credit, down payment, and loan size. So we're already learning an important lesson. A smaller down payment can turn into a permanent feeling monthly fee. Now let's build the monthly cost of the house, the real cost. People usually quote principal and interest because that's the number the mortgage calculator puts in big font. So we'll start there. Let's say you put 10% down. That's $50,000. Your loan is $450,000. Now we pick an interest rate range that fits the real world. Your rate depends on a few things, and credit score is a big one. In plain English, a higher credit score often gets you a lower rate, which gets you a lower payment. A lower credit score can raise the rate, and that can raise the payment by hundreds per month. For this example, we'll use something like 6% to 7% on a 30-year fixed mortgage. Your exact number will vary. The point is the ballpark. A $450,000 loan in that range can land around the high 2,000s per month for principal and interest. Call it roughly $2,700 to $3,000. Let's use $2,900 as a middle number. That's the payment people like to talk about. Now we add the parts that do not show up in those casual conversations. Property taxes. This depends heavily on your state and county. In some places, taxes are mild. In others, they're brutal. A safe way to think about it is, on a $500,000 home, taxes can easily be several thousand per year. And in many areas, it's much more. If we use $6,000 per year as a reasonable middle example, that's $500 per month. Homeowners insurance. This is climbed in many places, and it depends on where you live and what risks exist there. Storm risk, fire risk, flood zones. Even the cost of labor and materials matters. For a rough number, you might see $200 to $350 per month. Let's use $300. Maintenance. This is the one that gets ignored the most, and it's also the one that hits you at the worst times. A simple rule people use is 1% of the home value per year. Here's what that means. You set aside about 1% annually for repairs and replacement. On a $500,000 home, that's $5,000 a year, or about $417 per month. Some years will be calm. Other years you'll replace a water heater, fix a leak, repair a fence, handle HVAC issues, or deal with plumbing. The point is this. The house always asks for money eventually. PMI, if you put down 10%, Let's use $300 per month. And in many neighborhoods, there's HOA. Not always, but often. If there is, it can be $50, $150, $300, sometimes more. Let's keep it simple and assume no HOA for the base case. If you have one, your number goes up. Now add it up. Principal and interest, $2,900. Taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. That's $4,417 per month. And notice what just happened. The mortgage payment went from a number under $3,000 to a real housing cost over $4,000. This is why people feel shocked after they buy. The budget experiences the total number. Now we answer the next question. What income supports a monthly housing cost like that with breathing room? There are a few rules of thumb out there. One common guideline is keeping housing around 25% to 30% of gross income. Gross income means before taxes. Lenders often allow more. Lenders use something called DTI, debt-to-income ratio. Here's what that means. It's the percent of your gross monthly income that goes toward debt payments, including the mortgage, and also things like car loans and student loans. Many lenders will approve up to the low 40% range, depending on the loan type and the rest of the file. So lender approval can happen at a number that makes your day-to-day feel tight. Let's reverse engineer this with a conservative affordability target. If your housing cost is $4,417 per month, and you want that to be about 28% of your gross monthly income, your gross monthly income needs to be about $15,775. Multiply by 12 and you get roughly $189,000 per year. If you loosen the standard and allow a higher share, the income requirement drops, but the lifestyle pressure rises. A lot. And this is where the big conclusion comes from. A $500,000 home can be a normal home in many cities. The income needed to carry it comfortably is not normal for most households. Now you might say, okay, but people are still buying these homes. So who is doing it? There are a few groups. One group has two strong incomes. Think dual income households in higher paying careers with stable employment and a decent down payment. Another group has family help. Gifted down payments are a real thing. In some families, the down payment comes from parents or relatives. That changes the math dramatically. Another group stretches hard. They buy based on approval, then live tight. That is where the stress lives. So let's make this real with a household example. I'm going to pick a scenario that sounds strong on paper. Imagine a couple earning $165,000 combined. That sounds solid. That's far above the median. If anyone should be fine, you'd assume it's them. But gross income is not the money you live on. Once federal taxes, state taxes, Social Security and Medicare, health insurance deductions, and retirement contributions come out, your take-home pay can look very different. Let's give them a reasonable take-home estimate. It depends on their state, benefits, and how much they put into a 401k. So I'll keep it simple and realistic. Say their take-home is around $9,500 to $10,000 per month. Now we subtract the housing cost we calculated, $4,417. If take-home is $9,800, after housing they have $5,383 left. Now comes the part that makes this feel real. That $5,383 has to cover everything else. Transportation. Many households in the US have car payments. 2 cars is common. Let's say they have 2 payments totaling $900. Add car insurance, maybe $250. Gas, maybe $250 to $350, depending on commute. Let's say $300. Student loans. Some have them, some don't. Plenty of people do. Let's use $500. Health costs. Even with employer plans, there can be premiums plus out-of-pocket spending. Let's use $350 for premiums, beyond payroll deductions and copays across the month. Some months it's zero. Other months it's higher. Groceries. This varies a lot. If they're trying to eat reasonably well, groceries can easily be $700 to $1,000. Let's say $850. Utilities. Bigger home often means higher utilities. Electric, water, gas, trash, internet, phone plans. Let's say $500. Now add those. $900 plus $250 plus $300 plus $500 plus $350 plus $850 plus $500 equals $3,650. From $5,383, now they have $1,733 left. That $1,733 has to cover saving for emergencies, extra retirement investing, home upgrades, clothing, gifts, travel, entertainment, eating out sometimes, medical surprises, car repairs, and life in general. And here's the key detail. We already set aside $417 per month for maintenance in theory. In reality, maintenance does not arrive on schedule. It arrives in chunks. A $1,200 repair, a $4,000 HVAC issue, a roof problem, a surprise leak. So even if your plan says $417 per month, the real world says, here's a $2,800 bill. So this household can make it work. Yet the margin is smaller than people expect for a combined income that sounds high. And if they also have childcare costs, the story changes fast. Daycare in many areas can be $1,000 to $2,500 a month per child. Add that and the budget gets squeezed hard. This is what people mean by house poor. You own the house, and the house owns your cash flow. It's not about being irresponsible. It's about the payment taking so much space that the rest of life becomes a careful balancing act. And that balancing act feels like this. You start checking your account more often. You delay things. You feel tense when the car makes a noise. You dislike random mail because it could be a bill. You stop thinking in terms of goals and start thinking in terms of getting through the month. A lot of people accept that stress because buying a home is treated like a milestone, like you're supposed to do it. And sometimes it works out. Sometimes incomes rise, sometimes rates drop later and people refinance. Sometimes the home value climbs. Those things can happen, yet none of that changes the decision you make today. Today's affordability depends on today's numbers. So what do you do with this? How do you use this in a practical way? Here's a simple framework you can run in one sitting. Start with your monthly take-home pay. That's your real income after taxes and deductions. If you don't know it, check your pay stub or your direct deposit. Then decide what monthly housing cost feels safe for your life. A simple target is leaving room for three things: emergency fund, retirement investing, and normal living expenses with some breathing room. Now build the full housing cost estimate. Principal and interest is only one line. Add property taxes, add homeowner's insurance, add PMI if down payment is below 20%, add HOA if it exists. Add a maintenance buffer. Then compare that full housing cost to your take-home pay. If housing eats close to half of take-home, the house can start running your life. Some people choose that. Plenty regret it. And one more important piece, do not ignore closing costs and cash reserves. Even if you have the down payment, closing costs can be thousands. Then you move, you buy tools, you buy furniture, something breaks. This is why an emergency fund matters. A common goal is 3 to 6 months of essential expenses. A homeowner often wants the higher end because the home adds more surprise risk. So the best question is not, what price can I buy? A better question is, what monthly housing cost lets me keep building wealth and keep living normally? If you're looking at a $500,000 home, one practical move is adjusting the levers you can control. Down payment is one lever. A larger down payment lowers the loan size and can remove PMI. That can reduce the monthly number by hundreds. It's real. Credit score is another lever. Improving credit can lower your interest rate, and rate changes are powerful on big loans. Even a 1% difference can change the payment a lot. Location is a lever. Sometimes the same $500,000 buys radically different homes depending on region. That's not easy to change for everyone, but it is a lever. Home price itself is a lever. A $350,000 or $400,000 home can be a different monthly reality, especially with taxes and insurance, too. And there's a decision many people avoid talking about. Renting longer can be a smart move if it protects your budget margin and allows investing. People love to say rent is throwing money away. In real life, rent buys stability and flexibility. Buying a home you can barely carry can block investing and savings. And if you want long-term wealth, consistency matters. So here's the calm truth. A $500,000 home is affordable for some households in 2026. For many households, it lands outside the safe range. unless there's a big down payment, strong dual income, or outside support. The math is what it is. The goal is not to win a homeownership contest. The goal is to build a life that feels stable, a life with margin, a life where one surprise bill does not create panic. So if you're in the market right now, do this before you fall in love with a house. Run the full monthly number. Compare it to take-home pay. Add the rest of your real expenses. Add saving. Add investing. Then decide. If the numbers look tight, that is not a personal failure. That is information. You can adjust. You can wait. You can save more. You can shop a lower price point. You can improve credit. You can expand your search area. You can make a plan that keeps your future you safe. And if the numbers look healthy, that's great too. Healthy means you can pay the cost, maintain the home, save money, invest, and still enjoy your life. That's the standard I want you to use. If you want more videos like this, where we take money topics and make them simple and practical, subscribe to Liam Invests. If this helped, you can leave a like and watch more videos to learn more about personal finance, investing, and building real financial stability.